Hello and welcome back to Lean on Success, where process improvement is self-improvement. My name is Ben. I'm a Lean Six Sigma Master Black Belt, and today we're going to talk about how subprime borrowers are being targeted by the government. Now, before you think that I'm just talking condescendingly to those of you who might be subprime borrowers, I want to let you in on a little secret. My credit score didn't go above 600 until I was in my 30s. So I lived with bad credit for most of my adult life. And I pretty much lived paycheck to paycheck until I was almost 40 years old. So when I talk about subprime borrowers, I want you to know that I'm speaking from experience in addition to the data that we're going to share. The gist of today's video is going to be the government is desperate to get the business of subprime borrowers, and you absolutely should not give it to them. Before we get into all that, though, please hit that like button and subscribe to the channel for more content like this. Now, I want to unpack in this video the government's conniving plan to get bailed out by subprime borrowers. But in order to do that, I need to walk through a few definitions and review some things that we have talked about in previous videos. So firstly, let's review LTV, or loan to value. Now, in the previous video, when we talked about the used car market, we talked about how LTV is a calculation of how much you owe on a particular asset or vehicle, house, etc., divided by how much that particular quote unquote asset is worth. So for an example, if you have a mortgage of $100,000 on a home that's worth $200,000, that means that your loan to value on that home is 50%. Now, if you recall the unaffordability episode regarding used cars, remember the example about the $40,000 SUV that you had to take a $66,000 loan on. From an LTV standpoint, that's about 165%. The basic gist here is a low loan to value is generally considered good, whereas a high loan to value is considered bad or risky. There's another definition I want to go through, and that's something called DTI. This refers to debt to income ratio. Now, this looks more at your personal finances, and DTI is the amount of your monthly debt obligations divided by your monthly gross income. So for example, let's say that you have a $1,500 mortgage, you have that $1,100 car note that we talked about a couple of weeks back, and you have credit card payments of $400 minimum per month. That means that your monthly debt obligation is $3,000. Now, let's say that you have a gross income of $6,000. That means that you have a debt to income ratio of 50%. Now, it's going to be important to understand how these two metrics work, but generally speaking, low DTI is considered good versus high DTI is considered bad or risky. Same thing with loan to value. Low LTV is good. High LTV is considered bad or risky. Now, if you're going to talk about the housing market and the government, you've got to talk about the FHA, or the Federal Housing Administration. This particular department of the government offers guaranteed mortgages through a couple of different programs. The Federal National Mortgage Association, which you may have heard it called Fannie Mae, and the Federal Home Loan Mortgage Corporation, also known as Freddie Mac. Now, what's special about Fannie Mae and Freddie Mac is that they're actually not government-owned entities. They're actually for-profit private companies that are sponsored by the government and are given certain authorities and certain obligations by the government to behave in a certain way as it relates to the housing market. Now, if someone's interested in buying a home and they don't have enough cash to pay it outright, they can apply for a mortgage to finance the house. There are different loan types: FHA loans, VA loans, conventional loans, and other. Now, in this video, we're going to be talking exclusively about FHA loans, which comprise about 10% of the mortgages that are being purchased today. So why do people pick FHA loans over the other types? There are a few advantages. Firstly, the down payment requirements for an FHA loan is much lower than it would be for a conventional loan. Many FHA loans can be secured with as little as 3% down versus conventional loans typically require 10% or more down. Also, there's more lenient debt to income ratio rules. Another advantage is that people with bad credit or low credit scores can get FHA loans more easily than conventional loans. The minimum credit scores are lower for FHA loans. And in many cases, FHA loans also carry lower interest rates. So you actually can save a little bit of money on the financing part of the mortgage when you're choosing FHA. Now let's talk about how Fannie Mae works. You're a home buyer. You apply for an FHA mortgage to a particular bank or lender. Now, what happens is once they approve you, you sign over a mortgage to them promising to pay a certain amount, and the bank in turn gives you the money to purchase the house. You then take that money and give it to the seller of the home, and they give you the keys to your brand new home, or at least new to you. In the meantime, after the bank completes your transaction, they take your mortgage and they sell your mortgage to Fannie Mae. Now, we talked about why FHA loans are very attractive to home buyers. The requirements are a lot more lenient, and it's easier for someone with bad credit and not a whole lot of money to be able to get into a home. Now, the banks also find FHA loans particularly attractive for one important reason. All FHA loans or mortgages are guaranteed by the federal government. So the banks know that if they approve someone for an FHA mortgage, that loan is completely guaranteed. They don't have to worry about foreclosure. They don't have to worry about values going down. They don't have to worry about anything because they know that Fannie Mae will pick up that mortgage and the bank can walk away scot-free if something wrong happens. Now, obviously, this makes FHA mortgages very attractive, but also very dangerous. Now, that leaves us with two questions. Firstly, why is Fannie Mae incentivized to buy mortgages from banks? And where do they get the money to buy the mortgages in the first place? Well, this is how it works. Fannie Mae partners with thousands and thousands of different banks and lenders and buys up all of those mortgages. Then Fannie Mae and Freddie Mac as well takes all of those mortgages and bundles them into something called a mortgage-backed security. Think of it as like a stock or a bond that can be traded on the market. Fannie Mae then takes that security and sells it to private investors for money. They then take this money to buy more mortgages, to bundle into more securities, to sell to more investors, and the cycle continues. Now, I mentioned earlier that FHA mortgages can be very dangerous. They're dangerous, firstly, because Fannie Mae and Freddie Mac are required to buy any mortgages that are FHA approved, regardless of whether the numbers or the fundamentals actually work out or not. Now, what this means is if the demand for homes goes down like it is right now, that means that home prices go down. If home prices go down, those mortgage-backed securities that Fannie Mae is selling to investors go down in value, which means Fannie Mae loses money. Now, what all that means is Fannie Mae and Freddie Mac have a vested interest in making sure that home prices stay high, because that means that they can sell those securities at a higher rate and make more money. They're like any other private company. They're not interested in losing money. The problem is because demand is going down in the market, they've got to figure out how to increase their customer base and sell more homes without driving the price down too far. That leads us into the next part of what makes these FHA mortgages dangerous. Now, we covered in an earlier video how the mortgage rates have exploded in the last 2 years, which means the average home buyer has to pay almost double what they were paying 2 years ago in order to secure a home. This is what is directly causing the slowdown in home buyer demand that we've been seeing over the last year. Fannie Mae has two instruments in which they protect their profits. The first one is called MIP or MIP. The second one is called LLPA. We'll get into that in a moment. Now, these are risk mitigators that the home buyer pays for in the form of fees that are typically assessed at closing and could be spread over the entire mortgage. Now, MIP stands for mortgage insurance premiums. This helps FHA cover any losses if you foreclose on the property. So clearly stated, if you buy an FHA mortgage and they require you to purchase MIP, that's an insurance policy that protects them, but you're paying the premium. Now, earlier this year, the government put out a press release that basically announced that MIP was going to be going down on all FHA mortgages. In other words, the amount of the premiums that they were going to charge for that mortgage insurance were going to be reduced by 30 basis points across the board. Here is the chart that was included in that press release. What you can see is that across the board for all mortgages longer than 15-year term, the amount of the insurance premiums went down by 30 basis points or 0.3%. Now let's talk about LLPA, or loan level price adjustments. This is a fee that FHA charges homebuyers to help protect their profits when they're making loans. This fee is a percentage of the purchase price that is financed across the term of the entire loan. Now, there's a rate chart that FHA has built out that are based on the borrower's credit score and their LTV. So FHA has a rate schedule on all of the loans that are FHA approved that determine how much additional costs that home buyer will have to pay based on two primary risk factors. The first one is FICO score, which means how risky is the borrower. And secondly is loan to value, which is how risky is the loan itself. Now, this is a rough estimation that I put together based off of the rate charts that FHA uses to determine their rate sheets for the loan level price adjustment. And what I've basically done is given each of these sectors a grade based upon the quality of the loan overall. So in the top left, you see that represents home buyers that have credit scores of 740 and above that have LTVs of 70 or lower. Basically, anyone in this box are well qualified buyers. They have a great credit score, which means it's unlikely they're going to default, and they're putting down 30% or more, which basically means that the loan itself has very low risk associated with it. So we're going to call them A+. Now you can see that I've given kind of rough grades to each of these particular boxes to demonstrate how particularly risky the situation is based on the person's credit score. So top left, you've got A+, and the bottom right, these are people who have credit scores below 680 that are putting down less than 15%. This is what we would call our D customers or our D situations, because these are very risky borrowers that are putting down very little money to offset the risk of the loan itself. So this is the new rate sheet that goes into effect May 1st of this year for FHA purchases based on credit score and loan to value. Now, one of the things I want to point out on this new rate sheet is that a person with a credit score below 640 that's putting 25% down actually has to pay a higher fee than someone with the same credit score that's only putting 5% or less down. Now, already that's kind of a red flag, because why would a person who's putting down more money have to pay more of a fee than a person who's not putting down a lot of money? I mean, if you're putting down 25 or 30%, doesn't that make you less risky, which means that you shouldn't have to pay as high of a fee? Oh, but wait, there's more. Now, again, these are the new rates that go into effect on May 1st. This chart represents the changes of the rates that you see on the current rate sheet from what they were previously. It's the difference. Now, the red indicates that fees went up for that particular box, whereas green indicates that fees went down for that particular box. Now, what we can illustrate here is the box that got the biggest rate decrease as of May 1st are the riskiest borrowers, below 640 credit score, putting down 5% or less. Conversely, the boxes that got the biggest increase in rates are people with middle to good credit, 720 to 760, putting down 15 to 20%. And when I first learned about this, I was just flabbergasted. I just couldn't believe that they were going to make it more difficult or raise rates on people that had reasonably good credit, putting down a reasonable amount, but then cutting rates for people who aren't putting very much down that have a terrible credit score. It doesn't seem to make any sense until you think back to everything that we've talked about. Homebuyer demand is plummeting right now. The prices of homes have to stay high, which means they've got to keep selling them so that they can keep selling those mortgage-backed securities at a rate that allows them to make money. A lot of the smart money, i.e., people who are well qualified and are capable of buying, are starting to choose more and more to kind of sit out of the market because of how ridiculous the interest rates are and because of how high prices are, even though they're coming down. And so because the smart money is starting to leave the market, the government is pulling a Hail Mary by making it easier for not very well qualified buyers to be able to purchase homes. So as much as the narrative around this is talking about making homes more affordable for the little guy, in reality, the government is just looking for subprime borrowers to prop up their mortgage-backed security rates. Now, before you say that that's really not that big a deal, or, this is just a sign of the times and we've never seen this before, I want to remind you that the exact same thing happened right before the great financial crisis. Demand was starting to slow down because interest rates were going up and the homes prices were getting outrageous. So the government started making loans a lot easier and more accessible for riskier and riskier borrowers in order to prop up demand. And we know what happened. As unemployment started to set in 2008, these mortgages started to default, these lenders started to fail, and the entire economy collapsed. I'm not suggesting that things will play out exactly the way that they did back in 2008, but I can tell you the fact that the government is taking this level of risk to try to prop up demand, it means that they're getting desperate. And when the government gets desperate, bad times are ahead. Did you find any of this interesting? Did I get something terribly wrong? Did I bore you to death? Let me know down in the comments and share this video with your friends. Until next time.